Alright, what's up guys? Hope you're doing well. James here from jamesdforsythe.com, and obviously with the change of setting, back on the curve again, basically doing another video wherever I can since I don't have access to the truck, out of town for work, just for, I guess, historical reference or whatever. But with that being said, we're basically going over an article titled "The Financial Situation." This was written in the Financial and Commercial Chronicle in November of 1910. Basically, it illustrates it's giving a historical reference, right? Kind of a primary source for how American sentiment was towards central banking at the time, right? And it's really kind of to show how having a central bank in America, more specifically centralized reserves and decentralized banking, right? It's kind of getting into very technical arguments with like the Federal Reserve, how it's set up, that sort of thing. And it's really from Paul Warburg's kind of perspective, if you kind of get my drift. But really, basically, he's claiming that central reserves and decentralized banking was an obvious necessity and a novel concept at the time, more or less paraphrasing his own kind of words, right? So that being said, quoting straight from the article, one is led to think how easy it would be, theoretically, to construct a perfect banking and currency system for the United States under Mr. Warburg's guidance, and yet how beset with difficulties must be the task of putting such a system into practical effect, right? So this kind of emphasizes Warburg's role in kind of the creation of the Federal Reserve, and I guess this is kind of gives credence to where the whole idea of him being quote unquote the father of the Federal Reserve in a way kind of stems from. At least it's one thing that I've heard him referred to as, right? And kind of the study of the different points of view of the creation of the Federal Reserve and kind of where all this kind of comes into play, right? And so there are so many practical obstacles to be overcome in devising a scheme that shall be at once sound and workable that the members of the National Monetary Commission have as yet been unable to solve the problem in a way satisfactory to themselves, right? So this is really kind of before Warburg was becoming a part and kind of an active participant of the National Monetary Commission. And if you don't remember, that is the National Monetary Commission is that commission put together by Senator Nelson Aldrich in his first bill in the Aldrich-Freeland Act in 1908, putting that in perspective. And that's kind of known as the first Aldrich bill in a way, right? I'm sorry if it takes me longer. It's harder to read in the dark or under street lights. Let's see. So, but to take the crude system which we now have and to seek to adapt it to modern requirements, which means practically to uproot it in some of its most essential parts, makes the undertaking one of Herculean proportions, right? So it's really kind of painting the creation of the Federal Reserve as some kind of quote-unquote Herculean effort, right? And so it's kind of making it just kind of seem impossible, and you kind of see this later when Warburg's describing it essentially as the best thing that could ever happen to the United States, right? And that's almost explicitly what he calls it as, right? And so it's kind of really painting it as this almost mythical entity in a way. And so I guess you kind of still see that in today's kind of society, where you have the kind of general public views the Fed as some all-knowing entity in a way that has control over markets and all that sort of thing. And it's kind of placing unmerited control on it to a certain degree, right? Now, to which degree is arguable depending on your point of view, not the point of the video, so on, right? So to continue, it is at all events clear that the practical carrying out of the plan would at one stage or another of the process encounter innumerable obstacles and drawbacks, founded on prejudice and long established usage, which it would be almost impossible to overcome and which would fail to command for the new scheme at that general assent necessary to make it a success, right? So really kind of saying like, it's never going to work, that sort of thing, right? And that was one of the major kind of pushbacks for the Fed in general, or before its kind of creation, is there was a lot of back and forth on the very nuanced aspects of the bill. Like there wasn't a lot of consensus in that kind of respect, right? I'm not talking about generalized, like how it's kind of put together. I'm talking about like very new, like, okay, yeah, decentralization, but how much, sort of thing. Like there was one, I believe they wanted to have like each state had a different reserve bank, and they had another commission, I forget the name of it off the top of my head, where they're like, no, the optimal amount of reserve banks is like 5. And then they basically, in the bill, it said, in the actual drafting of the Federal Reserve Act, I believe it says there can be a minimum of 8 and a maximum of 12 regional reserve banks. And so basically, and there was like a whole commission about like how it was supposed to only be, they were going to just put it as 8 because then they could add them later, right? And that was also in the original Federal Reserve Act as well. And then basically, when they actually created the system, they just put 12 in there, right? A different story. We'll go more in depth in that later when we actually reach to that part of the book. So to continue, in a modern system, he argues, constructed on credit, cash must be centralized as far as possible into one big reservoir from which everyone legitimately entitled to it may withdraw it at will, and into which it must automatically return whenever not actually used. And so this is supposed to be a kind of a play on the whole elasticity of the currency itself, and kind of also the centralizing of reserves, right? And so the argument was, without all kind of bank reserves, for lack of a better term, without them being centralized in one kind of general entity or reservoir or system in general, to where they're based, or more or less, even though broken up into 12 different regional reserve banks, it's kind of operationally it's equivalent to one, I guess is where I'm trying to go with that, right? So basically it's more or less one central reserve that all member banks kind of draw upon in a way. And from there it's supposed to prevent liquidity crises, right? So basically, no matter where the bank is, they can always have access to reserves. Or instead of having their actual reserves being in multiple states away where they can't get it, or you basically have this kind of dog-eat-dog world where there's when there's a liquidity crisis, and then banks couldn't get liquidity, they couldn't get their reserves, or just enough currency in general. The classic bank run scenario. And basically, whenever they couldn't do that, you'd have other banks basically hoarding them, and there wasn't this liquidity, for lack of a better term, flowing throughout the system, to where if a single bank in one region needed it, or even just a bunch of banks in one specific region, they couldn't get the currency they needed to fulfill their obligations, hence the bank runs. And that was because other banks were hoarding it. So basically, the argument was, with a central reserve, with one central reservoir of these reserves or currency, you'd basically have optimal liquidity where there wasn't kind of a fight over them, right? So keeping that in mind, he also, and when I said he, a second ago in the quote, this is Warburg, it's his argument. And to continue on exactly what Warburg was saying, so the central organ must have power to request the banks to keep with it cash balances proportionate to the amount of their deposits owned by banks. In a footnote, he tells us later that the banks is always meant national banks, state banks, and trust companies, right? And so this is kind of the beginning thoughts of having reserve requirements in that respect, right? Specifically for the Federal Reserve, and then also like adding state banks and trust companies. Those are kind of also, I think the state banks, obviously we talked a little bit about that in the previous video, to where whether or not they could be reserved, or whether or not they could be member banks, and now there was some discussion about it, that sort of thing, and then trust companies as well, because this was written and the whole idea of the Fed and that kind of thing was kind of, I won't say drafted, but kind of started to be put together due to the panic in 1907, which was really kind of the main catalyst, I guess I should say, would be, I believe it's the Knickerbocker Trust. It was some trust company in New York, I believe, who had a major problem and then just kind of went from there, right? And so I remember it was trust companies, but I don't remember the exact name of it. And so to continue, as we interpret Mr. Warburg's plan, the central reservoir is not to be an additional reservoir, but practically the sole reservoir. It seems correct to say that cash should be centralized into one big reservoir, and that a financial system which quote-unquote scatters and decentralized reserves is wrong and defective. But recent experience and recent education is to the effect that it is not wise to burden the central institution too much or to rely upon it exclusively, right? So how much power exactly do you want to put with some central reserve? Okay, something to keep in mind. And that being said, right, because if you give them too much power, then it's like, hey, can kind of have a tyrannical entity in a way, or it leaves open the possibility for that to happen. Whereas with decentralization, you have that illiquidity problem we were talking about before. So kind of a cost benefit thinking about it, right? And at least as that's what it seems to be portrayed as in this specific article, right? Keeping that in mind. So, let's see. Kind of getting more of a perspective from the author of the article itself, not Warburg. So no objection will be raised to his statement that a system of centralized reserves and decentralized banking is clearly the system that this country requires. But the further conclusion that the country will gladly accept it when once it has this clearly presented to it in a definite form may be doubted, for it does not allow for the perversities of human nature or the influence of prejudice and the inclination of the part of the public to regard with suspicion the growth of centralization of power, especially where it takes the corporate form, right? So we're kind of already alluded to that with how much centralization and power do you want to give one entity. That as well, and also showing kind of public sentiment almost agreeing with the premise of the central bank in a way. And that's kind of the argument with why it's technically the Federal Reserve System and not like the ECB, like a single central bank, right? And kind of having it be decentralized banking with regional reserve banks, but you have one central reserve in that respect. And so also, again, we have this kind of reiteration of the country kind of doubting it being able to be implemented in a practical way. And this comes from the author of that article itself, right? And so, secondly, or I guess, I don't know, next, Mr. Warburg says that the United States Treasury should cease to deal directly with the banks. The central reservoir should be the recipient of the government surplus funds and should attend to the government's disbursements. The influence and business of the Treasury, a purely political body, must cease. So this is really kind of getting your separation of politics and kind of monetary reform in general, right? Keeping monetary and fiscal policy separate, right? Kind of seeing that come into play. And this, I wrote a note saying TGA, kind of where the Treasury General Account kind of came to be in a way, or at least the idea of one being necessary. So, yeah. Really kind of separating monetary and fiscal actions in a way, keeping politics out of banking. That was kind of a major push for the Fed as well, and also kind of the distribution of, we'll say, authority within the Fed and exactly why it was set up the way it was with like the different classes of, why is it skipping my mind? The board of directors for the individual banks having different classes, and then also the reserve banks boards of governors, right? So basically how they were voted by different people, right? Some public, some private. And that's where you kind of see that kind of differentiation where the Fed's like kind of half public, half private kind of thing in a way, right? So under this arrangement, the majority of the board of directors of the central institution would be appointed by groups of banks all over the country, leaving the government directors in a minority, kind of alluding to the different classes of directors, right? To where some of them are appointed by the government, some of them are basically voted by private bankers, and equivalent. So there is something very telling about his characterization of the folly of a system which makes the commercial paper purchased by a bank immovable assets. You know what? This is kind of getting more into the argument for the commercial paper market, which is kind of a bit further than I wish to emphasize in this video. Basically that, America didn't have a fully developed commercial paper market, and so basically banks were using, say, what's the exact frame? I think it was call loans on the New York Stock Exchange, that sort of thing, as kind of a extra source of liquidity in a way. To quote exactly, loans on stock exchange collateral, and really kind of getting into the fluidity of credit as a quote, and basically making that commercial paper more fluid and accessible by banks, right, to where it wasn't quote unquote locking up capital, which was contrary to how the European system was at the time, at least relatively. It was like the different number of signatures that had to be on said paper and a few other things, a few other nuances in there, compares it to Germany and that sort of thing. So finally, the principles that should apply are well understood, but how to secure acceptance for them and put them into practical operations is the problem which taxes ingenuity, right? And so basically, and this was written in 1910, so this is kind of after the major arguments, or the initial arguments, we'll say, for kind of trying to convince the country that they need a central bank in a way, or something that kind of revolves around a central bank, or could be related to, I guess you should say. But it's still like they need a little bit more convincing, right? And kind of a note going back to the TGA, the part on the Treasury that I was talking about a little bit before, it reminds me of another, I guess, kind of quick fact or whatever that I read in a book by Murray, forget his middle name, Rothbard. He's another well-quoted, I've noticed, economist / writer about this time period for the Federal Reserve, and kind of looking at more from a historical perspective. And I believe it was in 1907, or maybe it was earlier even, to where basically the Treasury itself tried to become a central bank. And he quoted, or not quoted, but I guess directly cited one of the Treasury secretaries who explicitly tried to do that during his time in office. Basically ran the Treasury like a central bank, and it apparently failed epically. But other than kind of, I guess, anecdotal evidence based off of just what Rothbard wrote, that's all I can say about it. I haven't looked much further into that specifically. But anyways, I'm going to leave this one here. So continuing on with this kind of series in a way, going on the Federal Reserve and more of its historical side of things, we'll go over the United Reserve Bank Plan from Warburg himself, before we kind of get into the Aldrich Bill and then the Reserve Act, and kind of comparing the multiple kind of different plans in a way, and really getting a more dynamic kind of cost-benefit analysis of different characteristics of the bills, right? But anyways, I'm going to leave this one here. So I hope you guys have a good day, and I will see you on the next one.